set the stage for even more volatility to come. Tim.
They do, but volatility isn't necessarily have to be bad and doesn't necessarily have to derail what's been one of the greatest two-year bull markets of all time.
In this video, the fast money traders acknowledge the potential for increased market volatility, but suggest it may not harm the ongoing bull market. They emphasize the significance of observing bond yields and note that the Federal Reserve is adopting a data-dependent stance. While there are concerns about rising rates and inflation, some traders argue that a sustained higher rate environment could still be manageable due to the strength of the current economy.
And that it's very clear within the Fed that is so data dependent that, look, if anything, we're now out to March at best on a cut. And yes, that's what the market is digesting. It's been a lose-lose market for equities and bonds over the last 5 weeks. We haven't done this since back to 2023, but it feels a lot like the early stages of when the Fed was telegraphing that they were hiking. We're not getting anything close to that. Of course, that was historic in terms of what they did in the end of 21 into 22 and 23. But markets came into all of this with cash levels for professionals at lowest levels we've seen in a long time, complacency, Bitcoin going through the moon. I mean, we came into this period of rising rates set up for volatility. Volatility, not comfortable, not always bad.
So an excuse to lighten up positions, or is the pace of this rise in rates, is that actually scary? Does that actually factor into a revised outlook for stocks for you?
Well, I think the bigger problem would be interest rates rising, which you bring up. And I think we're far away from that, so I don't think that's anything to consider. But you're starting to see more inklings and kind of the rumors of like people starting to talk about that. So when you're looking at no rate cuts happening this year, that went from a 13% odds to 25% odds when we look at today. So I don't think rates staying this higher for longer is necessarily a bad thing for the markets. They need to digest that, which is what's happening today. But if they stay there, I think markets can likely continue, but we just don't want to see them going higher. I don't think we're there yet, so I wouldn't really price that in.
I think we pulled a lot forward, but the way you opened up the show with that litany of data points, the fact that we're so close to all-time highs, isn't that something to take away? I think Tim touched on a lot of the good news in the marketplace. Mm-hmm. So if you went through that litany, the game that you always play, if you would have known the entry, where would the market be? And you could make the case that the market could be substantially lower than it is. The odds of Donald Trump becoming president again were probably pretty low, and as we got closer, it was still a flip of the coin. When he was elected, huge pro-growth, huge capex. So there were a lot of things that were really in the bull's corner. So I think the market is just adjusting, if you will.
Okay. There could also be a little bit of, Julie Beal, upon the election, there are all sorts of assumptions about all these pro-growth sort of policies. And as we get closer to Inauguration Day, there is this reality setting in that, you know what, day one, there could be tariffs. We don't know the extent of the tariffs. There are all these potentially inflationary policies coming down the pike, and we're at, 4.74 and change.
Yeah, I think that's exactly it. I think there was a recognition in the markets that we could have a higher level of inflation. But I think what people weren't necessarily expecting was that, other pockets of the economy would be as strong as they are. And I think this labor report really points to an underlying very healthy economy. And so I think taken together, it's getting very, very difficult for the Fed to be in any kind of position to be able to cut rates. For sure, I think they're going to have to stand still. I think the discussions that people that are starting to have about raising rates, I mean, I can't even imagine that discussion, 4 weeks ago, and suddenly I'm hearing it more and more. I think that's just a level of indication of how wide the cone of outcomes has become. And that happens anytime you start to really ramp up the level of uncertainty. And I think with this administration, that's just a reflection of the fact that the cone of outcomes is wider. We're going to have more volatility because we can't really predict outcomes. And I think it's really the time for investors to focus more on the fundamentals, because come earnings, that's when things are going to get trued up in the right way.